Okay, let's join Julia Lee from Bell Direct. Julia, good morning to you. I suppose really the obvious is with a spike in the Australian dollar, there's short-term, I suppose, excitement in the United States, and we've seen that Mark 1, Mark 2 of QE, and no different overnight. But net, what does it mean for corporate Australia? Is this a good outcome, or at 105 plus for the local unit, is this actually putting us on the back foot yet again?
Well, altogether, if we have a look at this announcement coming through from Helicopter Ben, it was more than what the markets expected. However, if we have a look at QE1 and QE2 and what that's meant for asset values and the Australian share market, it paints a bit more of a mixed picture. We saw QE1 from November 2008 till June 2010, and it did pack a pretty big punch. We saw things like copper prices up by a massive 63%. Gold in US dollar terms was up by 73%. Meanwhile, gold in Aussie dollar terms up by 32%. But if we have a look at markets, they were a lot more subdued over that period. The Australian market was up by 7% and the US market was up by 6%. I guess things were a little bit more difficult in those days with the Lehman Brothers collapse and the market coming off a lower base. But if we have a look at QE2, you can see that the effect diminishes. And QE2 ran from November 2010 until June 2011, but it was really priced into the market from September 2010. But if we have a look at that November 2010 to June 2011 period, well, copper prices were still up, but nothing like the 63% that we saw in QE1, up by a more modest 12%. I saw gold prices in New York up by 12%, gold prices in Aussie dollar terms only up by 2%, and the Australian market during that time actually decreasing by 2%, while the US market managed a gain of 12%. So I guess in playing QE3, some of the effects will be a weakening in the US currency, a strengthening in the Aussie dollar, and of course that's a key headwind for the Australian share market. So it could actually put a dampener on the Aussie share market, and traditionally we have underperformed our peers in terms of stock market performance. One area which benefits quite strongly is commodity prices. It looks like the industrial commodities will really get a strong lift, and of course gold in US dollar terms. But with the Aussie dollar expected to strengthen even further, this could be a headwind for Aussie companies making earnings offshore.
Interesting, because do you actually feel the Fed had to do this or not? Some are already writing and saying it didn't need to do this. Its dual mandate to ensure full employment and combat inflation pointed it in different directions, but political pressure won the day. Is that a fair call?
There is a view that Ben Bernanke did press the panic button and he looked at QE3. And if we have a look, it's an extraordinary announcement. We've seen Operation Twist being extended out till mid-2015, and then $40 million worth of mortgage-backed security purchases per month with no end date in sight. So it does look like it's pretty serious about trying to lift that employment situation, and it does seem to be all about jobs. We haven't seen a huge improvement in the job situation, and it does look like quantitative easing is designed to help the job situation and also the housing market in terms of the US. There is an argument on whether quantitative easing is effective, but really this is a race to debase currencies. It's an extraordinary world where last week we saw Super Mario coming out to try and save the European situation with the bond purchasing plan, and now we've got Helicopter Ben throwing buckets of money around to try and help the US situation. And over in Japan, some extraordinary moves throughout the global financial crisis. I mean, the central bank over there is buying exchange-traded funds as well as real estate investment trusts. Imagine if the Reserve Bank started to buy exchange-traded funds on the Aussie share market as well as property companies. So it is extraordinary times, and it looks like a lot of it is around the currency. The Fed, of course, its dual mandate of inflation as well as employment, trying to help the job situation there. But the lower US dollar has been great news for US companies. If we have a look at revenue for S&P 500 companies, a lot of it is offshore. And what we've seen in the last couple of years is strong earnings per share growth in the US, while the Australian market has really lagged behind. In fact, in the last earnings season, we've seen Aussie earnings actually down by 2%. And a key headwind there is, of course, that strong Aussie dollar, and that weaker US currency really expected to help those companies on the S&P 500.
Well, yeah, okay. Well, we agree, and we did see the ISM Purchasing Managers Index showing new orders in the US slipping to their lowest level since 2009. I guess you could say if they really feel as fair as he does, the US slipping back into recession. and he doesn't believe that politicians are going to do their bit of heavy lifting. He had no real option by default. He had to move, and he has quite startlingly overnight. Okay, the pass-through today is the kind of story and the shiver and all the kind of the seething resentment about what's going on in the mining space with Fortescue. Is that going to be cast aside today versus the end of yesterday's session, or will it still be in play when we come online?
Well, we're watching Fortescue very closely. We saw a drop of 14%, and I wouldn't be surprised to see the stocks going to a trading hold until there's a bit more clarity in terms of what's happening in terms of Fortescue and the talks with its lenders. There were media reports yesterday that it was talking to its lenders in waiving some of the debt covenants for around about 1 year. And of course, we've seen that tumble in iron ore prices. But today, it's going to be risk on. We saw the Dow Jones Industrial Average up a massive 206 points, the S&P 500 index up by 1.6%. We saw commodity prices at 5-month highs, with copper up by 1.5%, oil prices up by 1%, gold prices up by 2%. In fact, if we have a look at gold ETF inflows, we saw 25.4 million ounces of gold going into exchange-traded products overnight. In terms of sectors, it's going to be all about those high beta players, the materials, the energy, the industrial, the discretionary sectors, while those low beta players and those defensive areas like telecom, utilities, healthcare and staples expected to underperform. But altogether, if we have a look at quantitative easing and the impact in terms of sectors, it's a bit of a mixed picture there as well. If we have a look at QE1, the best performing sector was actually information technology, up by 35%, followed by the material space, up by 29%, and then the discretionary and staple space, which was up by 12%. On the flip side, we saw telecom down by 12%, property down by 18%. By the time we got to QE2, though, it was a very different picture, where we saw telecom up by 7%, healthcare up by 4%, the material sector actually only up by 1%, and on the downside we saw discretionary down by 12%. So it looks like while QE3 will have a positive impact in terms of the Australian share market in the short term, and the markets will rally on the back of this package that Ben Bernanke has delivered, which was ahead of expectations, I guess longer term it's still going to be dictated by that macro environment, and whether risk on or risk off on the Aussie share market is really going to be dictated by the macro environment rather than quantitative easing. And of course, that Aussie dollar is going to be a headwind.